Ladies and gentlemen, we got him. And by got him, I mean 250 subscribers on the channel. Let's go. Okay, so as promised, at 250 subs, you can click on my channel page, go to the community tab, and there will be a poll for you to vote in, and it will be for one of three stocks. These ones looked like they were the most discussed recently in the comments section of my various videos where I asked people to make suggestions for this poll. First one on the docket is going to be 3M. 3M has been a popular stock amongst dividend growth investors for quite a long time because of their relatively beefy starting yield and the very, very consistent dividend growth since the 1990s. Now, recently, the growth has gotten a bit slow. You see, the last couple, it's just been a penny each time. But it is growth nonetheless, and they do make up for it with a pretty high starting yield. Their payout ratio is about 60-ish%, which is not great, not terrible, as they say in Chernobyl. But basically, there's still room for it to grow, assuming earnings and such stay the same. The one thing beating down this stock as of late, if you look, it's price-wise, people are kind of seem to be avoiding this to a certain extent, and it's because there's this big class action lawsuit about these earplugs produced by a subsidiary of 3M, that 3M may be financially on the hook for some or all of that, for the damages to a lot of people's hearing. Now, there's two sides to that and everything, and I went over it, my thoughts pretty extensively in a previous video, so I won't get too much into it here, but suffice it to say, when it comes to class action suits like that, my feeling generally there is that the people who are actually, suffered harm don't quite get what they deserve. The shareholders kind of get screwed a little bit, and the real winners end up being the lawyers. So that's how I feel about that. But all in all, I would not mind having a little slice of 3M in the old portfolio. They make everything from face masks to Post-it notes. They just kind of quietly sit there producing and selling various items we use around the home and office every single day without even really thinking about it. So big, boring, makes a lot of money. Speaking of boring and makes a lot of money, Dow Inc. is a chemical company that was spun off from DuPont a few years back, and they are another suggested video. Now, they weren't as discussed this time as last time, but because they were the runner-up from last time, I decided to kind of throw them into the mix here as a bit of a dark horse, because the suggestions for them were pretty passionate, and that passion speaks to me a little bit here. So first thing that jumps out, high starting yield, pretty undemanding multiple of earnings, so it's a pretty cheap stock, at least on the surface of it. Payout ratio under 50% on the dividend. So with that, it seems like there's room for growth. However, there really isn't that much history to look back on, but there hasn't really been growth so far, but they have kept it the same. Steady as she goes. So, time will tell whether they're going to become a dividend increaser or not. But honestly, I wouldn't mind being paid the 5% starting yield to wait. So I'm cool with that. Next up is toot toot, here comes the money train. That's right. Union Pacific was by far the most discussed in the comment section, and is in my view, it's the favorite to win this whole conversation. Okay, you have a relatively premium PE in the high teens, but a pretty good starting yield, definitely a market-beating starting yield of over 2.5% on the dividend. Combine that with a payout ratio of under 50%. And really, like, honestly, this growth is pretty darn impressive in the last few years here. So this is definitely, from a dividend growth perspective, I think these guys are shining the most out of the three on the list. So I can see why members of the audience were particularly interested in this one. Also, being that it's, railroad, there are not really a lot of new railroads being built in the United States. So there's sort of monopolistic qualities to this. We still rely heavily on railroads to move goods across country. And this is, an army of one here. There's not a ton of, other options really. So if you need rail services, there's not too many places you can go. And that lack of competition basically means Union Pacific can afford to, raise their prices. They have some, pricing power because of that, I would say. And I think that's reflected in the growth in their dividend over time. They've been able to continually increase the amount they can pay out to shareholders because what they have is really essential, and not a lot of sources that can provide what they offer. All right, in terms of moving freight. Now, another thing I want to look at with all three of these companies is the shares outstanding chart, meaning do they buy back, do they dilute, do they stay the same? So we'll start with Union Pacific. So, and this goes back to 2009. They had about 1 billion shares outstanding in 2009, down to 624 million shares. So they've bought back about, it's definitely more than a third of their shares, not maybe just under 40% of their shares since 2009. Meaning, just by holding on to your shares in this company, if you had bought back in 2009, you would now have almost 40% fewer partners to split up the future profits of this company with. So that's really an impressive figure, and one of the quiet ways that companies return value. Now, everybody likes buybacks in the short run when they hear about them in the news, and stock prices generally see a benefit from it in the short run. But what's really the big thing that adds value is when companies just kind of quietly and consistently do it over a long period of time. Because any one of these, buybacks, gave you just, a little bit of growth in, how much equity your shares represent. But, when you take out, one way to look at this is if you had 3 partners in this business splitting up the profits back here, you're now easily down to 2. Okay. So that's, that's just mind-bogglingly, good and accretive to the shareholders, I think. So next up, 3M. Now they've got a similar trajectory here. Back in the day, they had about 700 million shares, down to 550 million. So again, that's a pretty big decrease. Not quite as much as Union Pacific, but still, that's a pretty good amount of reduction in the share count. So that future stream of earnings and cash flow is being split amongst a smaller and smaller amount of shareholders, which is what you want. It's basically the same as buying out partners. Okay. Now with Dow, honestly, it stayed pretty steady. I mean, it's overall decreased a little bit here, but the spinoff was only a few years ago, and I don't think there's really enough history here for us to judge how consistent they are with buybacks and whatnot. Now, considering the low multiple they trade at, I would like to see more buybacks from Dow, and it could be that they are planning on them. I have not checked into that, but certainly seems like something that they would be able to do, because it seems like they do have a lot left over after they pay out their dividend. So those are the 3 companies we have to choose from. Please go make your vote in the community tab. If you're not already subscribe, because I'll be doing the same thing at 500 and 1,000. And this is just me spending my money on the stocks that my viewers really, really want me to buy. Okay? Take it easy, and peace.